Continuing from our discussion on property classifications and tax rates, it is equally important for real estate professionals in Arizona to understand how property taxes are prorated between buyers and sellers at closing. Accurate calculation of these tax obligations demonstrates a licensee's commitment to reasonable skill and care, ensuring both parties are treated fairly during escrow. Errors in tax prorations can lead to disputes after closing and may be considered a violation of a licensee's duty to ensure complete and accurate financial communication under AAC R4-28 A101RH. In Arizona, property taxes are paid in arrears, meaning that taxes are assessed for the prior calendar year but billed and due in the current year. Each year's property taxes are payable in two installments. The first half due on October 1st, delinquent November 1, and the second half due on March 1st, delinquent May 1. Therefore, when property ownership changes, it is necessary to prorate the taxes between the buyer and seller to reflect who owned the property during which portion of the tax year. To calculate the seller's obligation, the escrow officer determines how many days of the year the seller owned the property up to and including the close of escrow, COE date. The seller is responsible for taxes accrued during their period of ownership, and the buyer assumes responsibility from the day following closing. The formula for prorating property taxes is annual tax bill, GARSH 365 days X number of days, seller-owned property, OCH, seller's tax obligation. Let's review a practical example. Assume the property taxes for the year total $4,280, and the close of escrow date is June 30th. This means the seller owned the property for 181 days, from January 1 to June 30. Using the formula 4,380, 365's 181, 2,972.33. In this case, the seller owes $2,172.33 for their share of the year's taxes. This amount would appear as a debit to the seller and a credit to the buyer on the settlement statement. The buyer will then be responsible for paying the full tax bill when it comes due later in the year, typically through their lender's impound account if financing is involved. If the taxes have already been paid in full for the year before closing, the prorations reverse. The buyer reimburses the seller for the buyer's portion of the prepaid period. For example, if the seller paid the full year's $4,380 before closing on June 30th, the buyer would owe the seller $2,107.67 for the period from July 1st to December 31, representing the portion of the year the buyer will own the property. It's also critical to understand that Arizona counties often provide estimated tax bills during escrow, since the final assessed amount may not yet be available. In such cases, escrow officers use the prior year's tax bill as a basis for proration. Real estate professionals must advise clients that prorations are estimates and may require post-closing reconciliation if the actual tax bill differs significantly. Case example: in Lewis versus Pleasant Properties LLC, 2011, a buyer alleged that incorrect proration calculations led to overpayment at closing. The court held that escrow officers and licensees must use the best available data and disclose whether the figures are estimates or based on actual statements. This case reinforces the duty of accuracy and full disclosure. An affidavit of property value is a sworn statement required in Arizona when real property is transferred, used primarily for property tax assessment purposes. It discloses the true consideration paid for the property, along with information about the property and the parties to the transaction. The affidavit is typically completed and signed by the buyer, grantee, although in practice, it is often prepared by the escrow or title company on the party's behalf and signed under oath by a party or authorized agent. The affidavit is submitted to and recorded by the county recorder at the time the deed is recorded, and the information is then provided to the county assessor, who relies on it to determine or update the property's assessed value, as required by ARS. Paragraph 11, 1133. Review summary. Property tax prorations are a fundamental component of every Arizona real estate closing. Because taxes are paid in arrears, sellers must compensate buyers for the portion of the year they own the property up to the close of escrow date. Conversely, if taxes are prepaid, buyers must reimburse sellers for the unearned period. The accuracy of these prorations directly reflects a licensee's professional competence and understanding of Arizona escrow practices. Discussion prompts. Why must property tax prorations be calculated at closing? Answer. To ensure each party pays only for the portion of the year they own the property. Maintaining fairness in the transaction. What is the key difference between Arizona's property tax system and that of states where taxes are paid in advance? Answer. Arizona taxes are paid in arrears, meaning the taxes for the previous year are paid during the current year. What happens if a licensee fails to properly verify tax proration figures on a settlement statement? Answer. The licensee may face client disputes or disciplinary action under AAAC R428-1101H for failing to ensure financial accuracy. Closing remarks. Understanding how to calculate property tax prorations ensures a smooth closing and demonstrates professionalism and care. This knowledge reinforces a licensee's role not only as a facilitator, but also as a trusted guide through the financial complexities of Arizona real estate. By confirming calculations, disclosing whether figures are estimates, and explaining the logic of proration to clients, real estate professionals uphold the standards of competence and integrity that define Arizona's regulated industry.